Peter Lynch, prepare for the worst and hope for the best. Prepare for the worst and hope for the best, a timeless saying often ignored by many. Today, we present to you insights from one of the most successful investors in history, Peter Lynch. And if there's one person who knows a thing or two about preparing for the worst, it's him. Lynch warns that 80% are not prepared for the next crash. And unfortunately, they think they are. Stay with us as we delve deeper into his wisdom and strategies that will enable you to emerge victorious when the next crash occurs. Later, we will conclude with an exciting investment opportunity. Let's get started. Lynch's track record and the importance of preparedness. Picture this, a man who turned a $20,000 investment into a staggering $560,000. Sounds like a fantasy, right? But for Peter Lynch, it was a reality. As the manager of the Fidelity Magellan Fund between 1977 and 1990, Lynch achieved an average annual return of 29.2%. Every dollar he invested turned into $28. However, despite his impressive achievements, Lynch emphasizes that many investors often lose money due to one fatal mistake: lack of preparedness for downturns. We live in a world of financial uncertainty. Market crashes, economic recessions, and sudden shifts in investor sentiment are part and parcel of the investing landscape. Yet, surprisingly, a large majority of investors fail to adequately prepare themselves for these inevitable events. They assume they are ready, but when the storm hits, they find themselves ill-equipped to weather the turbulence. Lynch warns that being unprepared during downturns can have disastrous consequences for your investments. It's not enough to revel in the highs of a bull market, you must also anticipate and be ready for the lows. The 80% who are unprepared often find themselves blindsided when the next crash occurs. But you have the opportunity to be part of the prepared 20% who emerge stronger and more successful. And here, we have a visual to make this long-term approach clearer. Let's take a look at this graph. This long-term graph shows the performance of a diversified stock portfolio over the years. What you see is not a steady straight line, but a series of ups and downs. But when you zoom out, look at the overall trend. The line is consistently rising. Despite periods of crashes, downturns, and corrections, the general trend of the market is upward. Over the long run, the market has provided positive returns. When we talk about long-term investing, this is what we mean. Those dips and downturns, they are the periods where many panic and sell. But the investors who understand their investments, who don't panic and who see these as temporary, are the ones who reap the benefits of that upward trend. Remember, the stock market is not a get-rich-quick scheme. It's a vehicle for wealth creation over time. And time is your biggest ally here. The longer your money is invested, the more opportunity it has to grow. This doesn't mean that long-term investing is without risk, but it does show that with patience and the right approach, it's possible to ride out the storms and come out ahead. Understanding businesses and avoiding junk investments. Imagine you're browsing through a catalog of stocks, trying to decide where to invest your hard-earned money. Amidst the plethora of options, Lynch offers a simple yet powerful piece of advice: invest in what you know. Understanding the businesses you invest in is crucial to successful investing. Lynch urges investors to avoid companies they can't explain to a 10-year-old in under 2 minutes. These often turn out to be what he calls junk investments. They are like shiny objects that attract attention but ultimately hold little substance or long-term value. Lynch reminds us that successful investing is not about chasing trends or getting caught up in the latest buzz. It's about finding companies with solid foundations, robust business models, and enduring potential. By investing in what you understand, you gain valuable insights into a company's potential for growth and profitability. Think about it this way: if you work in the technology industry and have a deep understanding of the latest advancements, wouldn't you be better equipped to identify promising tech companies? Or if you're an avid consumer of certain products or services, wouldn't you have a first-hand perspective on their popularity and potential for future growth? Lynch's teachings emphasize the power of knowledge and insight. He conducted an experiment with 7th grade students where they studied companies, assessed their solvency, and chose stocks. Their investments outperformed the market, demonstrating the effectiveness of understanding a company before investing in it. So, before you allocate your hard-earned money, take the time to research and analyze the businesses you are considering. Look beyond the surface-level metrics and delve into their products, services, competitive advantages, and growth prospects. This understanding will empower you to make informed investment decisions and avoid falling prey to the allure of junk investments. Segment 4: Lynch's Key Points for Successful Investing. Narrator, voiceover. Peter Lynch's wisdom can be distilled into several key points that are essential for successful investing. These principles have guided him throughout his illustrious career and can serve as a compass for your own investment journey. Firstly, Harness your natural advantages. Your unique experiences, knowledge, and insights can give you an edge in identifying potential investment opportunities. Trust your own judgment and leverage your expertise to make informed decisions. Secondly, understand the businesses you invest in. Avoid the allure of complex and incomprehensible investments. Invest in companies that you can explain simply and clearly. Focus on understanding their products, services, competitive positioning, and growth potential. Thirdly, adopt a long-term growth mindset. Successful investing is not a sprint but a marathon. Resist the temptation of short-term gains and instead focus on long-term value creation. Give your investments time to grow and compound. Next, research and analyze companies diligently. Do your homework and dig deep into the financials, industry trends, competitive landscape, and management teams of the companies you're considering. This due diligence will help you make informed investment decisions based on solid fundamentals. Remember to diversify your portfolio. Spreading your investments across different sectors, asset classes, and geographic regions can help mitigate risk and reduce the impact of any individual company's performance on your overall portfolio. Keeping your emotions in check is another crucial aspect of successful investing. Avoid making impulsive decisions driven by fear or greed. Stay disciplined, stick to your investment plan, and don't let short-term market fluctuations shake your long-term perspective. Regularly monitor your investments. Stay informed about the companies you've invested in and the broader market trends. While it's important not to obsessively check stock prices every minute, periodic evaluation and adjustments can ensure your investments remain aligned with your goals and risk tolerance. Learn from your mistakes. Investing is a continuous learning process. Analyze your past investment decisions, understand what went wrong or right, and apply those lessons to future investments. Embrace the idea that mistakes are opportunities for growth and improvement. Expand your knowledge continuously. The investment landscape is ever evolving, with new trends, technologies, and opportunities emerging. Stay curious, read books, follow reputable sources, and learn from successful investors. The more you educate yourself, the better equipped you'll be to make informed decisions. As Warren Buffett said, only when the tide goes out do you discover who's been swimming naked. This powerful statement serves as a reminder that during challenging times, when the market faces downturns or crashes, the true strength and preparedness of investors are revealed. Lynch's teachings highlight the importance of being prepared for the worst while hoping for the best. He cautions against the complacency of believing that we are immune to market downturns, as the majority of investors often underestimate the impact and fail to adequately prepare. By understanding the cyclical nature of markets and the inevitability of downturns, we can position ourselves for success. Are you among the prepared 20%, or are you swimming naked? Take a moment to reflect on your own investment approach and level of preparedness. Have you truly understood the businesses you've invested in? Are you focused on the long term and diversifying your portfolio? Are you staying informed and disciplined in your decision-making process? Now is the time to take action and ensure that you are well prepared for the next market crash. Know your shares well, have cash on the sidelines for buying opportunities, focus on the long term, diversify your investments, and remain calm during market downturns. These steps will help you navigate the storms and emerge stronger on the other side. Remember, investing is a journey that requires patience, knowledge, and an acceptance of both gains and losses. It's about learning from history, understanding businesses, and adapting to changing market conditions. By following the principles laid out by Peter Lynch and staying true to your investment plan, you can increase your chances of long-term success.